All right.
Welcome. We're getting started. If you came to talk about buying your paper, you're in the right room. There's been some shuffling on the schedule, but we're here to talk about BHPH funding solutions. You'll find that it's a little strange. I've got a microphone, but I'm not talking down the speaker. We're broadcasting live. This microphone is actually speaking to the audience outside. We do LinkedIn, Facebook, we're broadcasting with permission from the association. Yeah, this session is on BHPH funding solutions. How to get
Hold on, honey.
capital you need. Technical snag.
Yeah, just one quick sec. I'm not hearing your mic at all. So.
Oh, you don't? Testing 1, 2, 3.
Yeah, that's much better. Okay.
I forget there's a switch on it.
Yeah, there is. It's one of our extras. So, go ahead.
Nice. Shall
Would
we?
you like to restart over?
Shall we?
Again?
Yeah.
Okay.
So we're here to talk about BHPH funding solutions. And so again, I'm Jim Rhodes. I'm the founder of the Octane Group. We're a coaching consulting company. My lovely wife and business partner joined me in the consulting company about 1.5 years ago. And we have traveled all over the country. I personally, in my career, have been in more than half of the U.S. states, visiting buy here, pay here dealerships and finance companies, doing coaching and implementation work with them. And we do a lot of work with startups. We work with dealers that are brand new in the business. And I know we've got some in the room here who are brand new to the space. So we're happy to talk about that. And it's an area where we live. We've done launch packages and coached dealers into business for a long time. We're going to talk about that in particular. We're going to talk about all the different buckets that we're aware of in terms of funding solutions. And so we'll have a chance to talk about ways to fund the business. I've always said that it's been my experience in traveling across the country and working with dealers at all different levels, that it's been my experience that there are two types of structure that are really important in your business. And I feel like if you can get these two types of structure right, then you mitigate a lot of the risk that is buy here, pay here. And one of those would be the underwriting structure, the way that we fund the consumer, the way that we structure a loan for the consumer. Obviously, we understand the underwriting would have an impact on the success of the loan. But the other part of that is the funding structure. It's how we fund the operation. And this will be true whether the money is coming from an outside party, whether it's coming out of your own pockets and you're funding your business personally. We feel like it's really important. There are ways to introduce capital into this space and do it in a way that really mitigates risk. And that's all about putting dollars into contracts and earning assets and how to make sure that you optimize the capital that you invest. Go ahead. So some things to know, kind of a underpinning for what we wanted to talk about. You can go to the next slide. There's some kind of common things that I wanted to share before we get into the actual buckets of money, so to speak. One is there are some common mistakes. It was asked in our session this morning about what do we see that causes dealers to fail? What do we see as kind of threads or common denominators for success? And one of the things that I would say is, and we've talked about it, you can find in our podcast series, we have the podcast called Tote the Note. And we did a series with Brent Carmichael with NCM not long ago. And one of the things we talked about was what are the most common things that cause dealers to fail. And among the things we talked about and we shared this idea that when dealers move too fast in the buy here, pay here space, that's often dangerous. Now, have they done it well? It can happen. It's just that if you look at the field that was littered with people who have failed in the buy here, pay here space, I think what you would find most commonly is that they tend to move too fast, or they come from a retail used car sales or franchise background, and they get a little bit intoxicated by the gross profit that is buy here, pay here, and they just move fast and they just want more of it. And it's the recipe for disaster. So we're aware of that. It's also possible to move too slow in this space. And so we won't spend a lot of time there, but because the dollars get consumed in overhead, we just know that it's important to create contracts, create cash flow. And so if we move too slowly, that can also be a problem. But we'll see the other scenario more frequently. Discipline and consistency, those are also things that we We know that lenders and funding solutions like to see consistency. If they're going to be coming in and funding you against contracts that you have underwritten, they would like to see consistency in performance. And we'll talk about the areas where that matters. And then leverage, just the actual ratio. And I'm not a CPA, but we've worked with cash flow modeling with dealers. I built my own cash flow modeling tool back in 05, been using the same, different iterations of the same basic, it's basically a massive spreadsheet, but we do the projections and it can incorporate a related finance company and all those things. But when we do the math, the impact of leverage and just the borrowing rate, the percentage that you borrow against your portfolio is a really important number. And if we don't get enough, then obviously we starve for cash. If we get too much, then it obviously can eat us up in terms of interest expense. And so there's a balance there.
There are a couple things that I wanted you to expand on. Well, one is, I think I can probably, on the going too slow part, we did a podcast on Monday. No, what day was
Friday
it?
morning.
Friday morning. Yes, it was Friday morning.
A couple days ago.
And it was about how your buy here, pay here is like a bathtub. If you want to get a really good example about what we're talking about going too slow, that's a really great podcast for you to listen to about that. And it's about the first little bit of time that you're in business and just making sure that you get those contracts on the books.
Yeah. And the quick version for those of you that are new is like, if you think about your business, and this is not just true of buy here, pay here, but if you think about your buy here, pay here business as a bathtub and you put money in the bathtub to start your business, we all understand the bathtub drain is open, right? That's the overhead flowing out of there. That's the, utilities and rent, and that money's flowing out. So if we wait too long to start putting revenue streams into that, then naturally the money that we invest initially, too much of that goes out the drain, and it makes it's a hard thing to catch up from. So that we know that's an issue. Go ahead.
And then the other part was, when you talk about over leveraging, I would like you, if you would, to expand a little bit on that, because I know that there's a lot of capital providers that are willing to go to 70, 80 cents on the dollar for their if they are funding you. And I was hoping that you would just talk about that.
Sure.
For just a second.
We've got time. I think, and I don't really see 70. We see 65 on occasion. If you went to your local bank and they had an appetite for that, and they'd done work with other people with receivables, their typical default number on receivables would be around 65%. They might be willing to fund a rate of about 65%. But we recently did some modeling with a client, and it was a really great example on a single sheet of paper, like a single spreadsheet. You could see the impact of moving that dealer from 50 to 65%. Because I don't know who in the room is familiar with Ken Shilson, but Ken Shilson has been one of the foremost authorities in our space. He's really a CPA by education. He created the National Alliance of Buy Here, Pay Here Dealers many years ago. And he is, one of the foremost authorities on these kind of matters. And he basically says, if you really want to test your buy here, pay here business model, go back to your numbers, go back to your projections, and double your charge-off costs and see if you're still in business in a year. Like just doing your projections, go in there and double the rate at which you're charging off and experiencing repos, and just look and see what those numbers look like. So we did that with this client recently, a new dealer, and at 50% leverage, the dealer was still in business and in a favorable ratio with their lender after doubling their charge-off rate. But at 65%, they were underwater. They were getting under ratio with their lender at doubling their charge-off. So does that mean they're out of business? No, they could perhaps, bring money in from outside and recover. But the reality is they're getting underwater with their lender, getting out of ratio, and that's obviously hazardous to your health, when you have that kind of situation with your lender. So now we also talk about in this business, and we talked about in our morning session, I'll be quick about it, but generally speaking, we see people coming to buy here, pay here with really two different strategies or business models. Most models fall into one of these two strategies. They're either coming from a place of a focus on cash flow. They're investing money and trying to turn that money into cash as quickly as possible. So it's a cash flow driven strategy, whereas others may be plenty liquid and they're playing a much longer game, and they're okay with investing and growing and regrowing their portfolio and postponing cash flow for another day. They're just really focused on building and creating equity, and they can afford to wait for the cash flow. So it's kind of into those two groups, the kind of things to understand about some of the things. It's an important backdrop for what we're going to talk about in terms of buckets of money. And then the definition of earning assets. Like if you were starting your business and I was advising you and going through the cash flow modeling, among the things you would see me do, especially this is true when we work with dealers that are coming from the independent retail space or franchise business, they're used to thinking in terms of gross profit per car, gross profit per deal, sell 20 cars at a certain gross profit. And now that's what they have to work with. That's their gross profit. In our case, I asked them to start thinking differently and say, let's figure out what your overhead looks like in your buy here, pay here operation. We calculate that, whatever that number looks like. And now think of it in terms of number of contracts that we would need on the books at a $450 payment or whatever that looks like. Let's think of it in that way. How many contracts would we need on the books paying us $450 a month to cover our overhead? Okay. So that's an important number. And when we do projections for dealers, we ask them to think about that. I could map it out for you, but it's like if you're looking at a line graph, we would like to grow the incoming cash flow to a place where it covered overhead. And then we'd also like to see it grow on to the place where it's covering the cost of replacing inventory. That's a much bigger number. Cost of cars are up. And if you're doing some volume, that takes a while longer to get to that place. But when we get to that first number, we cross that line. When we cover overhead, now we can at least be comfortable knowing that whatever other dollars that we're putting in the business, that's going into contracts. That's going into earning assets. The first money that we put in was really, that's that bathtub drain, right? That's going into expenses. And so that's a different thing. Now, the next round of money that we can, as we continue to put money in, because now we've got cash covering our overhead, now we're putting dollars into earning assets. And we can afford, to make some mistakes there because the dollars that we put in are going into a portfolio, real assets. And so that's an important thing to think about because those things will come into play as you look to build your business from scratch, or you're looking to even grow and move into the next phase of your business. Now, funding the launch. This is about getting the doors open. And again, this is a space we live in. We meet a lot of dealers. And over the years, I've said, we'll meet a dealer who comes to us and say, I'm interested in the buy here, pay here space. I want to know. And so typically it kind of happens one or two ways. Dealer comes to me and says, Jim, I'm interested in the space. I've got $500,000 to invest. Can you tell me what a model looks like if I go that route? I've got a certain number to try to invest and I want to see what that'll create. Or they come to it and say, Jim, I'm interested in the business. Can you help me figure out how much cash it's going to take to do this model? Like I want to know, I think in my market, I can sell 30 cars a month with $1,000 down. Can you help me figure out how much cash that's going to take? So either way, we've got to really figure out. It's common for us to meet dealers who say, I've got $300,000 that I want to invest in the business. And now we run the modeling and it calls for $1.2 million over 15 months to get them to a place where it's cash positive. And now where are we at? Now it's like, and typically for us as consultant advisors, we run the numbers for them and they find out it's 1.2 million and we never hear from them again. It's just kind of the nature of how that happens. And so we're always looking for ways. We're always happy to meet people who provide capital to this space. And there are many. So we're going to get around talking about exactly who those are and how that works. So I think we all understand that when we're building a business of any kind, we could look at personal funds, our own dollars that we can invest personally. We could turn to friends and family for getting the business out of the gate. We could look at private investment. And we participate in a lot of meetings with banks, with private investors. If this gentleman's interested in a dealership and you've got dollars to invest and you guys want to talk about an arrangement where we're going to help you create an investment strategy, I've been in those meetings. Like we've helped create scenarios that can make sense. And we've done it with banks too. But it still would bring that same thing I talked about earlier, regardless of whether it's you as the investor or him as the dealer, we would be recommending a structure that can make sense. Because of our experience with the rate at which cash flows in this business, there's smart ways to structure that arrangement, whether it's a bank or an investor personally, or wherever that money's coming from. There's a smart way to make that work for both of you. But we just have to be really careful about that. So we'll talk about that. I think for today, I'd like to keep moving and just think about, most of us are familiar with SBA, Small Business Administration. There are loans available. We've had a number of dealers tap into SBA as a source. It's just important to remember that SBA, in my experience, will not fund receivables. So they won't They won't provide the funding that's going to go into those contracts. Inventory, working capital for your business, other kind of assets in your business. They'll do that sort of thing, but they're probably not going to provide you the funding for portfolio growth. So then microloans, I always try to make people aware of this. I actually just became familiar with these kind of programs maybe 5 or 6 years ago, but you can check your state. There in a lot of states, there are programs that it's mostly at the state level, and it's done in conjunction with either local lenders or local maybe chambers of commerce. There's a number of people that might form a coalition and provide funding solutions for people that are creating new businesses. The idea is, if I'm the state of Texas and I want to help you create business because you're going to create payroll in the state of Texas, I have an incentive to help you get your business off the ground. And so there are programs out there like that. They're typically a microloan. So I would just recommend check your state and see, because those are nice and clean, because they're typically going to be a fixed rate, fixed term, fixed term kind of deal. So, the one I saw back in Utah when I lived there was they would do a 5-year loan at 9%, simple interest, simple payment. It was easy to plan around. And so that's money just to be aware of. And so those are among the buckets we want you to know about. So the earliest options and how to create positive cash flow. I'll tell you right away that, there are funding sources even at the very beginning of your business. It varies by region. It even varies a little bit by state. But just be aware, we're going to pay more for that money in the early stages. Because if you're brand new to the business, I might be prepared to provide you funding, but I'm doing it at some risk, especially if I don't know your experience as an operator, and I'm willing to help fund your contracts, then I'm just doing it at some risk. Now, I could buy the paper. You might originate 5 contracts out of your own money, and then I would buy the contracts. That's less risk for me. I now own the contracts. I'm going to take that risk. But if you want to own the paper, which is really the work that Michelle and I do, we work mostly with dealers who are intending to build a business and build a portfolio themselves, own the contracts themselves, enjoy the income and the interest that comes from that, and also obviously enjoy the cash flow that comes from that. Now, you can sell paper. Some people do it. It's a means to an end. So for those not familiar, you would sell a contract. Quick example, you have a car that you price at $11,000. Customer gives you $1,000 down, and without factoring any of the add-ons, you're going to have a $10,000 note, just in a real simple example. Now, you could take that note then and sell it to a third party, a bulk buyer. Bulk suggests they really want to buy them in quantity. And so how many contracts is going to vary by the funding source, but in bulk, they're typically going to want to buy at least like 5 contracts at a time. So you're going to have the funds to create those contracts, and you'll sell them off in bulk, but they're going to buy it at a discount. That same contract that you got $1,000 down, you have a $10,000 note, they're going to buy that paper from you at 65, 70 cents on the dollar. So you're going to get $6,500 plus the down payment that you kept from the customer. And you just have to do the math and see how that, relative to your cost in the car, can that work? It can get you out of the contract. Now it can get you enough cash to cover your basis and keep buying cars and keep producing sales. But obviously, the reason they're in that business to buy that paper at 65% is because they enjoy the income now. They own the contract. They're going to enjoy that income. And so it's a little harder for us to create wealth, for ourselves long term when we're selling that paper off. And so we get that. We understand the math behind that. But that is a source. It's just not one that we recommend for our clients, because, again, we're trying to help our clients tap into capitalization that will help them own their own portfolios. And even one step further, we're typically helping dealers own their portfolios and service it themselves so they can enjoy that income, right? But it takes dollars in order to fund those and get it to a certain place. Now, payment streaming. Anybody in the room familiar with payment streaming? Anybody ever used that? You know the terminology? So payment streams are, in its simplest form, if you originated that same contract we talked about, customer gave you $1,000 down, you got a $10,000 note. Customers got a $400 payment to you on that contract. Well, the factoring company or payment streaming is really a form of factoring. They're going to come in and advance you a percentage of that payment stream. So often when you're new, it might be a 6 or 9 month payment stream. There are some 12-month payment streams. So if we take that real simple example, 6 months of payments times $400, that's $2,400 that are projected on that contract. But they'll advance you a percentage of that $2,400. And so you just have to do the math on that. Their table varies in terms of percentage that they pay on those payments. The table varies based on the term. 6-month advance might be 78%, 9 months might be 80%, or whatever those numbers look like. You would have to just talk to them and find out what those ratios look like. It's expensive money. When you do the math and kind of back into what's that discount, and if you translate that out to a 1-year equivalent APR, it's pricey. But it's like it's cash that's hard to come by. It's for all practical purposes, it's hard money financing. But it is a means because they have almost no qualifications on you as a lender. If I'm providing a payment streaming, your personal qualifications matter very little. The actual underwriting on the contract matters very little. It's just, they're just advancing you. They got to typically make sure it's a valid contract. They might want to speak to the customer and verify that it's a legitimate deal, but then they'll advance. So it's a means to get capital, but at today's car costs, if you're new, they typically don't want to do 12 months for you. And that just means you got to have enough cash. That's just kind of almost like supplemental cash. You almost have to have enough cash still to make up the difference on your typical contract. So we just know that's it's a means to an end, but it's an expensive one.
Now, again, novice, payment streaming also is, if they're going for like the 6 months, that means that they're the ones that are collecting the payment and the interest, right?
No, it's not quite like that. What happens is they will, in that same example, they're going to advance, and it varies. Actually, some of the payment streaming companies will allow the dealer to collect. Others it'll be a situation where they're going to require that the payments come directly to them until the full payment stream has been collected. So that's more likely scenario. But yeah, that part varies. I will say we have seen payment streaming companies that will provide that kind of funding and will allow the dealer to collect the payments and then remit the money to the payment streaming company. But some of them are just regional. Like some of the people we meet, they'll only do business in the 7 or 8 states in the Southeast, as an example. They're just, some of them are regional and they have very specific programs. But if that's something that could work for you, then, and this is true of anything we're going to talk about here, if any of the things that you hear us talk about could make sense for you, then just reach out to us and let us kind of take you through that. And we can make introductions. We can connect you with the people that do that. And I can just tell you, for our listeners here and our virtual listeners out there, with Michelle and myself, we never accept any referral agreements. So if I refer you to a lender, just know that nobody's paying us to refer you. We only accept compensation from our dealer clients that are paying us for consulting. But in this case, we might not even be under any kind of engagement. We'll just make a connection for you, refer somebody. Just know they're not paying us. If we refer you, nobody's paying us.
It's because it's the best fit.
Yeah, it's just among the ones we're familiar with. And obviously, after 20 years of doing this, to come to these conferences, you meet all the people, and we know most of them personally. And we just, as a rule, we're not going to refer you to a company where, if we don't know the people behind the company. Like, we need to know them personally. So, if we exhaust all those, then we could end up introducing you to somebody we don't know. But we'll tell you, if we don't know them, you're on your own. We don't know the people behind the company. So that's kind of been a standard for us over the years. But now, obviously, the other thing is floor plans. And for those not familiar, floor plans are really just like a line of credit, but it's attached to inventory. It's only inventory financing. And the reason that's problematic in our space is if I'm your floor plan provider and I fund you on an $8,000 car, you go to the auction and buy a car for $8,000, and I immediately fund you the $8,000, then, and that's possible, by the way, most everybody can access that almost immediately. There are tons of those providers. They're pretty aggressive, and they'll provide even a brand new dealer some floor plan financing. But if I fund you the $8,000 and then you turn around and finance it to him on $1,000 longer, but within days, you're going to need to make good. That full payment is going to come due, which means it's just temporarily, in the case of a buy here, pay here situation, you're paying a pretty high price to have use of those funds for a short period of time, you're still going to need the cash immediately upon funding that or financing it to a customer. You're going to need that cash. So it's really just it's a short-term bridge, and it's an expensive bridge. And so typically when we're working with a brand new dealer, we like to see our dealers at least bring enough cash to the table to be able to fund their inventory. And then we can help. Again, the contracts are earning assets. We understand inventory is also an earning asset in a different way, but at least with that, we can own the inventory. When it converts to a note, now we can draw against some funding source on the contract. And now we just replace the inventory and keep using our own cash. It's less expensive, and it gives you a lot more flexibility. Those floor plan companies can be kind of restrictive. I mean, they're going to hold your titles, and sometimes you have to jump through some hoops, and there are going to be some fees along the way. So we just know that it's kind of restrictive. When you're really focused on your buy here, pay here business, trying to grow your buy here, pay here business, it can be a limitation. So we like to sidestep that when we can. Now, private investors, obviously, with private parties, it's just the same as we talked about earlier. Private investment can make sense. Friends and family, typically early stage of a business, we're not going to make sense for angel investors or private equity firms. We're not big enough to make sense for them. So it's really going to be friends and family, somebody you know, and so there are ways to get there and make simple agreements. But I will tell you that there is a tremendous opportunity if we know somebody who is looking to invest and create revenue from an investment. I think buy here, pay here can be a wonderful place to do it. When structured well, it's a wonderful investment. It can be a really safe place to be. They're counting on you as an operator to manage and operate your business well in order to get that portfolio to perform and repay them. Go ahead. We see mostly like 10 to 12% in this market. Could it be done for less? Perhaps, but the perception of this industry that we're in is, it's perceived as risky. With our experience, we don't feel like it's as risky as the perception, because we know a lot of the risk can be mitigated. But again, if you're dealing with a private party who doesn't really know your business, they're probably not going to take time to really understand their business. It's like the thing I heard many years ago. If they're investors, I've always understood, tend to bet more on the jockey than the horse. Have you heard that expression? It's like, if they bet on the jockey, they're betting on you to execute the business, not so much on the business. So they're banking more on you. And so that's why I say just mostly they don't have to know your business really well. They're more likely to have a personal relationship with you that's such that they're willing to make that loan based on their understanding of you. What about them? Interest rate, I can't really say. That should be easy enough to find out. SBA would be affordable rate. I mean, that's government-backed loan. That would be a more affordable rate. But just I can't really say. And the ones that I saw in microloans are probably creeping up. Interest rates are creeping up. But the last microloan I saw was in the range of 9%, which for brand new company, that's a pretty reasonable rate. It's not bad. So it's a workable. You can make that work, especially in our buy here, pay here space when we're financing customers at a 21% interest rate or whatever that looks like in your case. But yeah, that's roughly the way to make that work. And the other thing to think about is if you're paying a private investor, let's say we're paying a private investor 12%. Well, the private investor, if we're structuring that deal in the way that I would recommend, we wouldn't be drawing from the private investor any more than about 50% of the notes. So if you created $200,000 in notes, for example, you would only be borrowing from the private investor about $100,000, about no more than about 50%, which means in this real simple example, I'm saying you would be paying the investor 12% on 50% of your portfolio, and you would be earning from the customers about 21%, or most dealers are going to charge at least 18% on this type of financing. So, but you're collecting that on 100%. So the margin and the spread is sufficient for you to be able to make it work. So just know that's roughly the area we're working in. And then there are other industry programs out there. And today I didn't really necessarily want to name names of companies and providers, but just know there are some other funding solutions out there that are, I'll call them creative. They're not quite point of sale. And for anybody who's listening who's not familiar, that point of sale would be if I'm an indirect lender and you create a contract with him and I agree to buy the contract before they ever take delivery. I provide you a price, we agree on terms, and so I'm a point of sale lender. And so we basically come to agreement on terms. You contract with the customer and you get funded from me immediately because we had an agreement at the point of sale. Okay. So that's what we would call, a point of sale situation. There are some that function almost like point of sale where you can get some funding. You'll know what kind of funding you could get immediately. It's just that the rates vary on that. And so just come see us if you're interested in any of those kind of things. We're aware of some of those programs and we can talk about that. They're not a lot of them, but there are some out there that are pretty creative. Now, the bigger buckets, when we start to think about growth funding for our business, we start to move into a segment where there are some providers that will provide capital for growth. Now, what's it going to take to qualify with them? That is going to vary a little bit, but some of those folks are here at this conference. Like we know some of the folks who provide lines of credit, for example. And so when it comes to the place where you're going to kind of take that next step with your business, then you can do that. And I've kind of left out at this point, I should stop and make sure we talk about, there are, I guess I did say right there, lines of credit local. So we have seen it happen. I mean, typically, my joke has always been that, if you're my local banker, Mario, and I walk into you to say, hey, I want to borrow some money to create a buy here, pay here business. I want to borrow good money from you and I want to turn around and give it to people with bad credit. Typically, that's a pretty short conversation. I might be offered a ballpoint pen. Thanks for coming in, but it's a pretty short conversation. So banks don't typically have an appetite for that. And generally what you'll hear from them is that banks don't want to provide, if it's a customer they wouldn't finance themselves, then they probably don't want to provide capital to you to fund that kind of a contract. Generally speaking, that's what you're going to hear. But having said that, we have seen local lenders have an appetite. If it just kind of depends. It varies by market. It varies by lender. As we know, we could talk to 3 lenders right here in our community, and their appetite and threshold for risk would vary. So we just have to kind of talk to all of them and find out. But at the end of the day, if you're going to get a line of credit early in your business, it's going to be based more on you than it is the business. It's going to be based on your own experience. It's going to be based on your personal net worth, credit score, perhaps. There are going to be things like that they're going to look at, and they're probably going to want to ease in. They're going to provide you a small line of credit and kind of test the waters. And it also might be based on, like say, net worth. They might want to take some real estate as security, or whatever other way to secure the loan for them. But we have seen that work. And I've also been to many of those meetings with a new dealer and a new bank and be there with the meeting for the first time. And we can help them understand why it makes sense. But it's better, that conversation is better had 6 months in, 12 months in. We've got a little history on your portfolio. You've funded the contracts yourself to a point, and now you can sit with them with some history of your portfolio and have some history of cash flow to be able to have an intelligent conversation about and help them understand why it makes sense. Now, industry lines of credit, as I said, there are some of those providers here. We know them quite well. I would say it's a fairly short list of the people in our space that I would describe as industry-specific providers of lines of credit. People in the line of credit business, specifically tailored to buy here, pay here. There are some that are quite large and will do, $10 and $20 million kind of lines of credit. There are more that are going to want to start you out at about $500,000 to $1 million and be able to grow with that. So we would say there's more to be to access in that particular group. But the ones that I would call industry specific, it's uncommon for them to provide funding from day one. They typically need to see some history, because think about it. If you're a brand new dealer and I'm going to provide you a line of credit, especially if I'm going to allow you to collect from the customers and then you're going to remit payment to me, you might have a wonderful business plan, but if you don't have a history of an experience with collections, then I'm taking a bit of a risk by providing funding when I'm counting on somebody else to collect who's never had an experience doing that. And so that's something we need to be aware of. That's part of the limitation, in that particular scenario. Now, hybrid programs, what I'm calling hybrid would be any mix, again, of these creative solutions. There are programs out there that will kind of, when I say hybrid, it's almost like a point of sale. It might be, you'll hear things like payment share. They'll fund you an amount like a an initial advance, almost like a point of sale type of arrangement, but you can participate in the payment. So a payment share kind of, so again, it gets kind of creative, and programs vary on that. We can't go into all the particulars, but just know they're out there, and there's ways to fund your contracts. And a lot of those, again, are available even from the earliest stage of your business. So it's something to be aware of. And then private equity. As I said earlier, private equity, most of us are not really candidates. It doesn't make sense for angel investment firms, private equity firms to get involved in our business when we're pretty new. But when you start approaching $5 and $10 million, that can make sense to them. But we just don't see a lot of that. That's typically in private equity, that's typically going to be your growth that's 10 million plus, and it's typically a pretty aggressive business model. Those are the ones that kind of make sense for them. But we've seen private equity come in and out of the buy here, pay here space. We know people that have had quite large acquisitions where private equity was involved. But again, we're talking about when your business is at a more mature stage, and typically private equity is looking for a really big upside. Typically, if they're going to come in and fund your business at this stage, they really want to see a strategy of explosive growth. That's what they're really investing in typically. And that's not always the strategy that we're adopting in our business. So again, it might not always make sense. And then mergers and acquisitions, we know that happens. It doesn't happen a lot with the dealers that we work with, because most of the dealers we work with are small, they're medium-sized communities, medium-sized portfolios. We recently did a survey or a poll in Facebook from some of these groups that are buy here, pay here specific. And the results that we got back said that, I forget the percentage, Michelle, do you remember how many of the dealers said? The overwhelming number was that most of the dealers in that group have a portfolio size of 1 to 5 million. And it was by far the largest segment in that poll. So that's roughly the size of what we're talking about. And that's, while it sounds like a nice number, in reality, when it comes to acquisitions, that's really not typically the kind of acquisitions that you would see at that level. Acquisitions are more likely to be a higher level. Can it happen? Yeah, of course. What we're typically seeing is that mergers and acquisitions happen with larger operations. Okay, so that's just something to know. We also talked about in an earlier session. So again, we recorded and we broadcast that session live, so it's out there on YouTube and Facebook and these other channels, so you can find that. In that session, we talked about some of the ways that dealers can get funded and ways that you exit the business. So this is among the things that we talk about when it comes to exit and succession planning. For those that were not in the room this morning, I'll give you the quick version of the story. A gentleman that we know out of Alabama works for a company called Peachtree Planning, and one of the things that they do is exit planning, succession planning. Like if you've got a family member who wants to buy the business, or you want to sell it to one of your competitors because you're choosing to go invest in something else, then you could exit the business. Well, Mark Burkholder with Peachtree Planning says, if you get invested in the buy here, pay here business, you're going to leave the business one of 3 ways. You're either going to sell your business to an insider, family member, employee, somebody in the inside. You're going to sell your business to an outsider, or you're going to die at your desk. It's a pretty dramatic scenario, but he said that's scenario number 3. It's one of those 3 scenarios, kind of the way you're going to leave the buy here, pay here business typically. So, we credit Mark for that expression because we find it generally be true. And if we're not going to do that, if we're not going to die at our desk, then that means we have to position ourselves for, what does an exit look like? How do we create value in our business so that it's going to have some value that could be translated to another party? If I want to sell my business to you, what would you be looking for in my business in order to make it make sense for you to acquire? Those answers will vary, right? But we know that there are some common things that we would be recommending that a dealer create in their business to make it more marketable, to make it more valuable, and make it make sense to translate it to another party. So again, we think effective capitalization can be part of a successful exit. We know many of the folks that are listening today are not thinking about exit. They're just trying to build and survive in a difficult time and buy here, pay here. But we also think it's appropriate to think ahead to what that exit looks like, because when we can decide on an exit plan, whether that's 3 years for you or 10 years for you, we know that helps us to make judgments now about our business, rate of growth. What do we, how fast do we want to move? What's our expansion strategy? Is it one location? Is it 3 locations? What does that look like for you? Well, if we know what an exit looks like, because that might vary, your decision to exit, how you might choose to stay in the business or get out would be different maybe than his answer. And so we just recognize that. But if we think if you make that decision, get some feel for how you'd like to one day exit, then that might affect how you would choose to capitalize the business. Okay. So the rate at which you would do that and what sources of capitalization you might draw on to do that. I think we're probably about wrapped up, and we probably need to get to questions. Yeah. So that's kind of very high level. Obviously, we're not naming names of providers. We're not getting very specific about some of these creative funding programs. We just tried today to introduce you to the different types of funding that are available. So again, if any of you have questions about any of the specific products or programs that we mentioned, come and see us. We're happy to make introductions to people that might have a capital solution for you. So here's our contact information. If we can help you after the event, that's a way to reach us. But if we've got any questions today, I'm happy to take a minute to answer questions. Anybody got anything? Go ahead. What's that? Say again?
Usually no more than 5 years old, I'm guessing.
The cars?
Yeah, the cars that year.
The age of the cars? No, actually, we see dealers being quite successful with cars more than 5 years. More than 5 model years old, you mean? Yeah. Yeah, we see dealers doing that. In fact, now, obviously, with high cost of car, that we're seeing dealers have to adapt their business model in order to make that make sense. But a car that's 5 years and newer is more appealing as collateral to some would-be lenders or funding sources. Everybody's model varies, so we just kind of have to go out there and see. But no, it's absolutely possible to do higher mile cars and cars with more age than that. So for those who didn't hear the question, we're just talking about, he's asking about 5-year model years, and no, it's entirely possible to do it for cars older than that. Other questions? Nothing?
All right.
I know we got some folks who are brand new, so we must have really done a good job of presenting the information, so you didn't have any questions. So the question for our listeners out there on the virtual side is, besides capital, what are the problems that we see early dealers or startup dealers have? It's a number of things. It's really going to be sourcing inventory and reconditioning inventory. So it's just assuming that we did have ample capital to fund, we can acquire cars, we can sell the cars and access funding on the contracts. I would say one of the biggest challenges we're seeing, one would be just acquiring enough cars. Cars are the high cost of cars. So I always say, look, it's easy enough to go buy cars, but cars that fit your business model, that fit your strategy, that's a little different thing. And so that's one of the challenges. And then also we're hearing a lot of problems with reconditioning. It's hard to find techs and to keep in your service department. It's hard to find, all the shops are busy because they also have tech shortages. And so getting cars through the reconditioning process is also quite challenging. So these can be among the bottlenecks that we hear about. Personnel, staffing our own dealership has been challenging just because of all the things that we've seen changing in the employment sector. It's just among those, and obviously other businesses face those challenges, but those are among things that we see dealers, wrestling with. Sometimes marketing, but marketing in our line of work, for those of you that are not been in it, typically if we put up a sign that says we provide financing regardless of past credit, we can typically, find some buyers. So that part is less challenging. Typically, we're providing a solution that, we're providing funding or a finance solution for a customer who otherwise doesn't qualify for conventional financing. So they're typically thrilled to have that solution. So marketing is usually lower down that list. Other questions? We'll wrap it up there then today. I appreciate you guys tuning in. Again, you know how to find us if you have specific questions about any of these particular subjects.